if we do have a faltering economy for whatever reason, I think the Fed will cut. Keep in mind that the way the Fed thinks about these things is that as inflation is coming down, if they don't move rates lower, they are actually tightening. And so they have an implicit bias to ease now. Now, that said, right, in the 1970s, inflation came down and it came right back up. There is absolutely no assurance that inflation will stay down. And if the economy is holding up, why bother lowering rates?
Stock markets are rallying today on Monday as the S&P 500 is up about 0.8% and the Nasdaq is up more than 1% as of 1 p.m. Eastern Time. We're speaking ahead of several important central bank policy meetings this week. The Federal Reserve, the Bank of Japan, the Swiss National Bank, and the Bank of England, just to name a few. And these central bank decisions will have great impact on the market, so stay tuned for what's coming up next. Could these central banks surprise us both to the downside and upside? In other words, can this rally in the stock markets be sustained? We're here to talk about these themes with our next guest, Axel Merk, President and CIO of Merk Investments. First, a shout out to our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the IRA space for cryptos at 1%. It also offers unique tax benefits, so if you're over 18 and you like to open a new account or roll over an existing account, click on itrust.capital/David in the link down below to get started. With Bitcoin reaching new all-time highs and nearing above $65,000. Well, this may be a good time to look into an IRA to safely park your Bitcoin returns. Axel, good to see you again. Welcome back to the show.
Great to be with you again, David.
I think I'll start with this question. This came in from a viewer, and he was wondering why it is that markets globally, except for China, have been rising to new all-time highs, including gold and Bitcoin, despite the fact that global liquidity is drying up, despite the fact that interest rates still remain high, and despite the fact that the Fed still has not cut rates, Axel. What has driven these rallies?
Maybe it's all priced in and we live happily ever after. Maybe it's that markets can be irrational longer than you can remain solvent. Right now, part of it is that the market, I believe, is pricing in somewhat of a Goldilocks scenario where the Federal Reserve is somewhat on the tight side, but not too tight. And at the same time, AI is going to take over the world and is going to make us ever more so productive. You might sense a little bit of cynicism here. I am not quite as optimistic about some of these things, but definitely the glass is half full right now.
Is it possible for gold to overtake stocks this year in terms of percentage gains?
Anything is possible, of course. The gold can be quite volatile, and obviously stocks can also go to the downside. Historically, the correlation of gold to risk assets, S&P 500 and the like, is zero. But it doesn't mean that it's negatively correlated. It means sometimes positively correlated, sometimes negatively correlated, sometimes it does whatever it wants to do. And so in this context, there are clearly lots of things that aren't priced into the S&P. The quote-unquote Mac 7 have been pushing all-time highs. Maybe, I don't know, Mac 5s or 4, whatever it is, right? That's narrowing. And so it's possible that the S&P crumbles if more negative economic scenarios are priced in, and that's of benefit to the price of gold. That's certainly a possibility.
Well, it occurs to me, Axel, and please correct me if I'm wrong, but historically speaking, except for a few exceptions, gold is negatively correlated with risk appetite, risk on appetite. And so whenever we see stocks rising, we usually see gold lagging behind. It's not exactly the case in the past 6 months when gold has risen to new all-time highs. Now, the last time we saw both risk assets and gold rise at the same time was during 2020 when the Fed initiated quantitative easing, unlimited QE. So perhaps the markets are pricing in another round of QE down the line. Is that what's in the cards? What do you think?
Well, the closest to that is maybe that we aren't in that tight an environment to begin with. And to unwrap that a little bit, keep in mind that the Federal Reserve has at least tried to take some tail risks off the table. Just under a year ago, the Federal Reserve gave downside protection to regional banks by converting what was then an acute problem into what I would call a chronic problem. But they're not going to go bust, and with that, taking a lot of other things with them. At the same time, this is probably the most forecast recession ever that hasn't come yet. And so there's a lot of preparation that these companies have had to come in. Now, that said, there are clearly some signs that this economy is weakening. And then the Federal Reserve indicates they may ease later this year. And so is that equivalent to QE that we've had before? I don't know. I never gave QE that much credit, but by all means, we are in an easing mode, even if we haven't taken rates down yet.
On that note, I think investors are confused about positioning and sentiment right now. Right now, Axel, if I were to ask you to deploy capital right now, fresh from the start, would you be more risk on or more defensive?
If you aren't confused, you haven't been paying attention. And I cannot give specific investment advice. I can tell you that I've been an insider buyer in our gold mining fund. And so that is more on the speculative side, I would say, but it's in the context, of course, in what you can afford to do. Keep in mind that cash pays a decent yield right now. So if you need the money anytime soon, why bother taking any of these risks? I've been not adding any money to my personal S&P 500. But then again, right, historically speaking, if you're not in a recession, S&P is a decent place to be. And so if you have long enough a horizon, I'm not going to hold anybody back. This is not, I wouldn't say this, not in 2007 where I got rid of all the stocks that I held, so to speak. I think it's important, if not imperative, to think about diversification, and it can even be beyond the stock market. I bought some forest last summer, for example. I mean, you can do all kinds of other diversification.
Okay, so this year would probably be a year of diversification, not specific sector allocation. Is that what basically what the message I'm getting from you?
2 years ago, diversification didn't work. And since then, if there is some good thing about the post-pandemic environment is that diversification may work better again. Again, I am skeptical that risk assets are going to go great, but I don't see, let's put it this way. I don't claim to have a crystal ball. I don't think any of your guests do. What I think my role is, and that presumably of many of the other guests, is to make people aware of the risks that are out there and then have them decide whether they take them into account in their portfolio allocation, given the constraints that they have. So it's not like I can say, hey, the S&P is going to do this or that this year. What I can say is that maybe Goldilocks is not what happens in practice most of the time. And what do you do to prepare for those scenarios if you think you need to?
I want to come back to the stock markets and monetary policy, but let's talk about gold in a bit more detail right now. When you think about the drivers of the gold price, traditionally, they've been a few things, either higher inflation with the expectation of higher inflation, lower real interest rates because they're negatively correlated, lower US dollar, or perhaps higher geopolitical risk. Now, let's take a look at these variables. Inflation has not been going higher. It's just been flat around 3.2%. The real interest rate is actually going up. The US dollar isn't collapsing. And yes, there's been heightened geopolitical risk, but there's no major wars breaking out that involves the US right now, right? So what is driving this gold rally? Going back to my first question.
Yeah, so first of all, inflation moving higher is historically actually not correlated with a higher gold price. It's the real rates going higher that tends to be a dampener on gold. And the reason is that when inflation ticks up, there's the perception that central banks will do the right thing. And therefore, the price of gold tends to go down. It's only then with a lag that people realize, oh my God, maybe the central bank didn't do the right thing. And then the price of gold moves higher. Historically, the price of gold is correlated to longer term real rates. And people often tell me, well, who cares? Nobody knows what 10-year real rates will be. But what they are is they're confidence indicators of how confident how confident the market is in the central banks. So that's where I see a correlation. But again, it's somewhat murky, that correlation, because it's not a steady one, it's not a permanent one. The one thing, of course, that has happened, you're pointing to geopolitical risks, and I'm talking less about, oh, there's a crisis in Ukraine or the Gaza Strip. It is the signaling of the US that if you hold US treasuries and are a hostile nation, that may be at risk. And that is an incentive to other central banks to diversify out of the dollar. There aren't many good options, but one of the options is gold. And if you look at the gold holdings, notably also in China, they have steadily risen and have been an active buyer in the price of gold. And so there is a real buyer there. And beyond that, of course, the markets are forward-looking. So I've argued that if you think that we're going to have a recession, notably a more severe one, then gold is a good place to be.
Could it be possible, Axel, that the rise in the gold price in the last 6 months has little to do with market perceptions, but more to do with central bank buying of gold over 2023?
Well, it's supply and demand, and they are clearly a buyer. So that is certainly a contributing factor. How strong a factor? Anybody needs to think about. If I look at the market, the good thing is that people disagree. There's buyers and sellers there. The way I look at the gold market, to just take a step back, right, is I think there's the gold buyer that is worried about the purchasing power of the dollar. There's the gold buyer who buys gold because of diversification, and then there's the speculator. And so the person who is concerned about the purchasing power of the dollar does concern the buyer who's concerned about the deficits. That's part of that. Real rates and that what we just talked about is part of it. The diversification buyer, I think, is there, and we have seen them increasingly so. We have seen advisors invest in physical gold as well, in part because diversification works better than 2 years ago. The speculator we don't see so much. They have gone up to meme stocks and cryptos, but they can come back in a heartbeat. Should there be a straight line up or down in the price of gold?
And your outlook for gold, I know you don't give specific price targets, but in today's current macroeconomic landscape, is what we have today conducive to higher gold prices? In other words, are we seeing more risk off?
Well, we have, if you just take, well, before we go to risk off, we have both Republicans and Democrats think they can spend like there is no end in sight. We always say that we're going to spend money on the better thing if we just elect the right politician. Deficits are going through the roof. So long term, I think incentives for government and savers are not aligned. And it's one of the reasons why I hold gold for the long run. In the short run, of course, you can look at many other factors, but I tend to be a long-term investor. Sorry, I missed the other part of your question.
Yes. Basically, do you think today's macroeconomic landscape is conducive to higher gold prices?
Yes, except I've never been a fan of buying gold because there's a crisis in the Middle East, because they tend to be temporary. Now, the reason why it may not be so temporary after all is I'm increasingly coming to the conviction that the peace we've had since World War II, relative peace anyway, in the world is coming to an end, and that what we have in Ukraine and the Gaza Strip are just symptoms of a new era that we're in. And so if you believe in that, then yes, that is a reason to buy something like gold for more defensive reasons as well.
In a world where other central banks are perhaps raising rates, the Fed is looking at cutting rates. What does this mean for interest rate differentials and ultimately the dollar?
It's going to be very interesting because obviously a lot of people have been negative on the yen. And the question is, if they come out of that, what does that mean? And is it going to be disruptive? What I care about is there going to be disruption somewhere. If rates were to rise too much, it would be very detrimental to the Japanese budget. And so they cannot afford for those rates to go higher. And the main risk I see is that the market acts in a way that the central bank doesn't approve of, intervenes, and then fails to intervene. If that were to happen, then there's going to be a lot of volatility. If everything goes exactly as central banks are planning, maybe it's going to be a non-event for the US dollar, but the risks of something going wrong there, I think, are significant.
What are the major risks for the US dollar then this year?
Well, we were at peak rates. We are declining. The one of the risks is that this economy is worse than currently predicted by our wonderful economists, and that they have to cut more sharply. Historically, when central banks start cutting rates, they do cut significantly more than is priced in. What's somewhat different this time around is that they've gotten more and more shallow in their rate cuts, in part because this economy has had the appearance of holding up better than many have expected. And so the question is that sustainable? And I tend to be in the glass half empty camp. I don't know whether I'm right on that, but that could definitely be a reason for the dollar to weaken. Obviously, when we look at things like the dollar index, which we should when we talk about the dollar, because that's the benchmark many people look at, Europe is the main comparison. Now, Europe is a mess. But just because you have a mess doesn't mean you have a weak currency. And so Europe is going to play its role, and the euro is somewhat depressed, but they will probably do what they've been doing for a long time. They will muddle through, and that could well lead to a stronger euro. I'm not endorsing the euro wholeheartedly, but you're asking about risk to the dollar. I think the risk is that the euro is going to be much stronger than many people think.
Is that because partly of a faster recovering European economy versus the U.S.?
No, because the euro isn't as sensitive to economic growth is. If the European economy is stagnant, that in itself can create a stronger euro. Keep in mind that they have a war on the Eastern Front, and it's just being paralyzed can create a stronger euro. And it's countries with a significant current account deficit whose currencies are very growth dependent. Think New Zealand, Australia, where that's well known. And so the euro dynamics are often a little different what people think. And so if they just do what's priced in, and then in the US it's a little weaker than expected, that can well lead to a stronger euro.
On that note, actually, when we're talking about conflicts in Europe, the Red Sea attacks have been disrupting global trade. I'm reading this report from the IMF actually that came out just last week, March 7th, 2024. In the first 2 months of 2024, Suez Canal trade dropped by 50% from a year earlier, while trade through the Panama Canal fell by 32%, disrupting supply chains and distorting key macroeconomic indicators. I know this affects Europe more than the U.S. just based on proximity. Do you think Red Sea attacks or disruptions in that region will either A, heighten inflation in the region, or B, worst case, bring the entire region into some sort of economic recession?
Well, I mean, first of all, it's a higher cost of doing business, inflation, right? And that's a global phenomenon when trade is impeded. And how much does it matter? I do think it does matter. Regarding global conflict, yes. I mean, if those things persist, and right now it looks like they just might, procurement channels will change, and the market will adjust over time. It's disruptive in the interim. I'm trying to talk as abstractly as possible because at the other end of the spectrum, we're talking about something as abstract as the dollar or gold or the economy. But all those things are headwinds, and all of these things are a risk. Now, some of these are priced in. You can look at the forward markets about what the market thinks the price of oil will do and whatnot. But by all means, the U.S. has not been able to keep the pirates and the attacks at bay as much as they would have wanted to. And we can go into politics as to why that may be. But I think it's part of that broader theme that the U.S., for better and worse, is no longer the global policeman as they had been.
Okay, well, let's talk about something a little bit less abstract, which is the Fed funds rate here in the U.S. Now, the CME Fed Watch tool is pricing in basically a 0%, 1% chance of a cut by Wednesday. So markets are expecting no change. This is because the last couple of inflation reports have been harder than expected. Looking at these inflation reports, Axel, how confident are you as an investor that the Fed can cut rates at all later this year?
Well, it will be dependent on growth for the most part. If we do have a faltering economy for whatever reason, I think the Fed will cut. Keep in mind that the way the Fed thinks about these things is that as inflation is coming down, if they don't move rates lower, they are actually tightening. And so they have an implicit bias to ease now. Now, that said, right, in the 1970s, inflation came down and it came right back up. There is absolutely no assurance that inflation will stay down. And if the economy is holding up, why bother lowering rates? Now, at the same time, they're not going to hike rates in this sort of environment. And so they either do nothing or they ease. Now, the odds of them easing less is if the economy holds up better than expected. Keep in mind that the January reports, by the way, that were released in February, in my view, they're always utterly useless because there are revisions for the previous years in these reports, so they're super noisy. And if you look, and so you need several months then of data to decide of what's happening. We have an economy that's adjusting. People are reluctant to lay off people because it's been difficult to hire people. And then you have these tail end hedges that where it matters historically in real estate. You have all these, you have banks who are reluctant to sell real estate, so they don't have to recognize the losses. So things are happening more in slow motion But overall, I think uh, it doesn't mean the banks haven't big issues. And at some point, the bank will be, the Federal Reserve will be more courageous, telling the banks to clean up their act. And for that, they may well require lower rates to be able to do that.
Well, some people have told me that the banks, the biggest risks facing the banks, especially the regional banks right now, is the commercial real estate sector. I think you've alluded to that. How
Well,
at risk
yeah.
would be that sector? Yes.
Well, I tried to so eloquently say the Federal Reserve converted an acute into a chronic problem. The regional banks are a political problem. It's not so different, I think, than the savings and loan crisis in the 1980s. And what they have in common that it took a decade to fix. There is so much political power behind not confronting these small banks, and they'll just drag them on. The Federal Reserve, we saw it in Japan, and they can keep a zombie banking system alive. They can provide the support. It doesn't fix them. The implication, though, is that these banks will be lending less. Now, we've seen a lot of private credit try to come into that space to take their place. That works somewhat for some aspects of the market that these guys are serving. And the market will adjust, but it will overall, it's a headwind to economic growth. And I think that's how we should look at it. Obviously, the tail risk is somewhat contained if the Fed comes to the rescue.
What's your view on fiscal policy? What do you think will be the priorities of, well, two-part question, the remainder of Biden's administration up until the election, and then if he becomes reelected, what will his priorities change, if they change, and if Trump gets elected, what would his priorities be?
Well, broadly speaking, the deficits will be severe. Both Democrats and Republicans have learned that you can have an economic stimulus anytime. I mean, as much as I appreciated some of the tax changes under the Trump administration, it was a stimulus when we didn't have a recession. Now we had inflation because the stimulus was so high. Opposition to that has been rising. And there is no easy answer. Defense spending should go up dramatically. Given the threats in the world. That hasn't been happening. Maybe a Republican government, well, they'll spend more than the Democrats do. Will they spend enough to address the threats in the world? If not, then down the road, if indeed a real threat emerges, much more money will need to be spent. And at the other end of the spectrum, right, all the social obligations we have are tremendously expensive. Now, there are fixes to some of those, but the political will doesn't seem to be there. And so it doesn't really matter who we elect. I think our deficits are going to be quite significant as far as the eye can see.
Okay. So before we move on to the final part of our conversation, which is Merck Investments itself, generally speaking, then let's sum up your outlook for 2024. What is your thesis for economic growth or contraction, and ultimately the theme of investing for 2024?
I think this economy will be weaker than many people are predicting, certainly than is priced in right now. And in that context, diversification is helpful, meaning beyond the S&P 500. And we do gold and gold mining. It doesn't have to be that. I mentioned cash and other things may not be so bad either, but only take the risk that you can afford to take, anticipating potentially higher volatility.
Okay, so let's talk about Merck Investments. Yes, you do gold and gold equities. I want to go back to an earlier statement you made, which is that you've deployed a bit more capital into the gold equities because it's more speculative. Why is it that gold equities are more speculative? I understand many of them are junior companies and they're speculative by nature, but I've also heard the argument that gold equities, large and small, are really just a leverage play on gold, which is in itself a safe haven asset. So I can understand where there may be some, I guess, confusion around how to label a gold equity. Yes.
Well, if you just look at the volatility of the prices, then the volatility is high in gold mining than gold. And of course, in theory, you're right. You have a fixed cost of gold, getting the gold out of the ground. And then as the price of gold rises, you have a leverage to that. In practice, of course, you're taking on many additional risks, notably the management risk. In the junior mining space, you're really buying an option on them being able to develop a mine, which creates a whole host of other risks. And notably, one of the reasons why, especially the junior miners, underperformed in the higher for longer environment is because they have periodic funding needs. And so in an environment where the Federal Reserve has made it a priority to restrict funding, guess what? Those companies have struggled to get access to funding. And so there are significant additional risks. Now, obviously, that also brings opportunities, right? And if you do have an economic downturn and the Federal Reserve switches to be easier, that segment of the market tends to do well. In a severe recession, S&P type of equities tend to perform poorly, and those junior miners, historically anyway, have an opportunity to get a more significant boost because people are aggressively looking for diversification. Right now, people are only looking for diversification to have an outlook of a more negative market, whereas in a severe recession, more people are scrambling to do it, and that's part of the reason why those securities then get an additional boost.
In a bull market where people are looking to deploy capital into speculative assets, the junior gold miners will be competing with a lot of different things, including tech stocks and cryptocurrencies. And so when you're talking to investors who are looking to diversify into these speculative assets, what in particular does a gold stock offer that a token in the crypto space or perhaps a tech stock does not?
Well, they're all little different spaces. So when we say speculative, I don't mean speculative in a bull market, actually speculative in a bear market more so, because when equities perform poorly, that is a speculative way of diversifying, right? Cash is the quote unquote safe way of diversifying. Gold is a more assertive way, and mining stocks more, and then junior miners even more so. So you wouldn't buy, I'm not going to make a recommendation on NVIDIA, but if we had a severe equity bear market, then you wouldn't buy that stock necessarily because that's speculative on the upside more so than potentially in a bear market type of scenario.
Wait, just to clarify, so there's no confusion. Are you suggesting that during a bear market, gold equities could outperform the S&P?
Definitely, because they are historic, definitely as in could, not that they will. I have to,
right.
my speech is censored, so I have to be clear on that. But when equities perform poorly, then people are looking for diversification, and depending on the context, it is quite possible that miners do well. I'd just like to point 2008 as one of the prime examples. Not that we'll have a repeat of 2008 necessarily here, but equities tank, but people are looking for an opportunity in gold and gold miners, in part as a reaction to the change in stance at the Federal Reserve, but also because there's an opportunity for extraordinary gains in that segment. So it is a defensive move, but it's also very speculative. That's what I'm pointing out, and that's why there might be a confusion in the world. So I cannot say that gold miners are quote unquote safe, because they are not. But people looking for diversification from risk assets tend to veer towards gold and gold miners.
Okay, so let's talk about your strategy. How do you pick gold miners? What's the criteria that you use to first screen and then ultimately select the management team?
In our closed-end fund, selecting the management team is probably the first step, because it's all about being able to execute. It's all about being able to develop an asset and being able to have access to funding, also in tough environments. You diversify in geography. Most of these companies are incorporated in Canada, but that they, of course, have their mines throughout the world. There's always political risk in some of the places they do. There's risk on getting the permits for the mines and so forth. But that's why you need to have a good management team that knows how to execute, that has a track record. And what we do is we come in a little earlier than your mutual funds or ETFs do, because we have a closed-end fund and don't have the same daily liquidity sort of constraints than others do. And that allows us to come in at these funding rounds that are earlier, and that helps to institutionalize assets, meaning that at the next funding round, little bigger players can come in. And when one participates in these funding rounds, rather than the share prices going down because of dilution, they tend to move higher because they have money for the next phase in their development.
Just to clarify your strategy, do you only buy common shares that are already floating in the market, or do you participate in private placement deals as well?
We participate extensively in private placement deals. Many, not all of them, are publicly traded. But in the gold mining space, a lot of companies go public quite early, so it doesn't mean there's a lot of liquidity. And most investors don't have access to these deals. And so it's one of the ways that individual investors can access these deals by buying a fund like ours, because we participate in those deals at good terms. And one of the things when one participates in these deals is there are often warrants issued, and that provides an incentive or an economic leverage that if they succeed, and it's incentive for both management and the party participating in them, when they reach their target, then you can exercise these warrants, and that gives the company more funding if one exercises the warrants as well. And so there is some implicit leverage that one can gain through participating in these deals as well.
Suppose a management team that may be relatively new to the space or doesn't have a phenomenal track record, somebody who isn't a Ross Beatty or a Rob McEwen or so on and so forth, approaches you and pitches you their stock. What are some of the first questions you would ask to vet whether or not they would be successful in actually, developing this project?
Yeah. Our portfolio management team talks to a lot of people, even to people that have very little chance of getting funding, mostly to learn more about activity that's happening in the space. My portfolio managers have been to many of the sites around the world, and a lot of these sites are developed near bigger mining sites. So one of the things one thinks about always is the exit strategy down the road. So if you develop a mine near to where Newmont is, well, maybe they might acquire them later on. So that might be a contributing factor. That said, if an inexperienced management team approaches us, the odds are very low that we might help them in their growth.
Okay. You wrote a recent article, and I'll just read part of the first paragraph here. Saba's siren song, alluring promises but misleading. Saba recently sent ASA, one of your funds, investors, a letter stating eliminating the fund's discount would generate a 20% gain for shareholders. Saba's nominees have been successful in reducing discounts in dozens of similar situations. What's your reaction to this letter?
Yeah, so for context, the closed-end fund most of the time does not trade at net asset value. When you buy an exchange-traded fund, it very closely mimics the underlying value of the investment. And the reason is that there is an arbitrage mechanism in the market that allows that gap between the net assets and the market price to close. In ASA case, that's our closed-end fund. That fund was launched in 1958. We've been managing it since 2019. And there, no shares are issued and redeemed on a daily basis. So the underlying net asset doesn't trade at the market price, but trades at a discount. There are some activists in the market, most notably Saba that you mentioned, that has made it their business model to approach these funds. Last year, they had 64 of these campaigns running, where they want to somehow close that gap between the discount and the market price. When that happens, there are a few things that will happen. Most of the time, or always, all the time, you don't close that discount for good. You do it just briefly for some people to be able to make a quick buck, so to speak. The remaining shareholders are left holding higher expenses, or the expenses that have to be spread across fewer shares. The big challenge with ASA, and there are many challenges, we can talk for an hour about it, is that because we are investing in this mining space, in the junior mining space, these holdings are fairly illiquid. So imagine if they succeed and they make an announcement that, okay, we'll buy back 25% of the shares outstanding. That means we would have to sell the holdings. The signaling to the market alone would, in my view, apply significant downward pressure on many of the mining stocks that we're holding, because we have to raise money to facilitate that tender offer, or share buyback, whatever it may be. And so there are a lot of things that are somewhat unique about this closed-end fund that we believe Saba hasn't fully evaluated or may not care about, that we think could be detrimental to investors. And by the way, I happen to think it's also bad for the space as a whole. If they succeed, we think the ultimate solution may well be the liquidation of this fund. And if that fund weren't there anymore, there would be yet another player that's missing in providing funding to these junior companies. Now, obviously, the investor's goal is to make money, not to help these junior companies. But we also think that most investors in this closed-end fund buy ASA because it is differentiated from the ETFs and invest in these junior mining companies.
Generally speaking, from a fund manager's perspective, what are the advantages of managing a closed-end fund versus an open-ended one?
Well, the key advantage is, of course, that you don't have the daily liquidity. If you go back into the mutual fund space in the long bear market we had last decade, a lot when you have redemptions, you have to sell the liquid holdings to facilitate the redemptions, and you're stuck with your dogs with the because not all of these companies will succeed, and you want to spread your eggs. And so if you have redemptions, you have to sell the good stuff and keep the bad stuff. And so that in the closed-end fund, you can be a long-term investor. We think there are many advantages to it, and most investors in ASA really appreciate that.
Okay, well, we appreciate your insights today. Thank you very much, Axel. Where can we learn more about your work and Axel Merk investments?
On Twitter, you can follow me at Axel Merk. And then what we do, merkinvestments.com is probably the best starting point. And from there, you can see the various things that we do. We also have a newsletter there that you're more than welcome to sign up for.
Okay, very good. Thank you. We'll put those links in the description down below. Thank you for watching. Don't forget to subscribe and like and follow Merk Investments in the links in the description.